What do donuts, outdated department stores, and a nearly bankrupt home flipping app all have in common? They all became the hottest stocks of the summer without any actual good news. We're talking 300, 400, even 500% price spikes, followed by brutal crashes that left latecomers holding the bag. Welcome back to Meme Stock Mania. Same chaos, new victims.
Welcome to your Money on Easy mode with Damien.
This time, it wasn't GameStop or AMC, it was Opendoor, Krispy Kreme, and even Kohl's suddenly skyrocketing for no clear reason. Fueled by Reddit threads, TikTok hype, and a sprinkle of FOMO, meme stocks were back in 2025 and louder than ever. But here's the twist. Underneath all the rocket emojis and diamond hands is a pattern that we've seen before. Irrational hype, shaky fundamentals, and a ticking time bomb for the unprepared. In this episode, we're pulling back the curtain on this summer's wildest stock moves, how they happened, why they matter, and what every investor should watch for before jumping in on the next viral train. You'll walk away with a sharper BS detector and a strategy to stay smart even when the crowd's shouting, "To the moon!" Remember, I'm not a financial advisor, and the info I share here is for educational and entertainment purposes only. Always do your own research or chat with a professional before making any big financial decisions. If you want to know how to actually invest the smart way, boring, proven wealth building, check out my full episode titled How I Invest. It's all about index funds, low fees, and real diversification. Now, ready to trade those paper hands in for diamonds? Let's go! Summer of 2025 saw meme stock mania return with a vengeance, reviving memories of the 2021 GameStop frenzy. In late July, a motley crew of companies, from a struggling department store to a donut chain, suddenly shot up 25, 50, even 70% in just a matter of days. And yet, just like an internet flash mob, this hype came seemingly out of nowhere. None of these firms had major news or booming earnings to justify such leaps. Instead, the fuel was social media buzz and sheer speculative fever. It looks like meme stock mania is back, bringing the same mix of excitement and chaos that we saw 4 years ago. Let's set the scene. Kohl's, a big box retailer many considered to be past its prime, soared 37% in a single day, so fast that trading was temporarily halted to cool things off. Krispy Kreme, the donut company known for hot glazed carb comas, saw its stock jump 26% in one session, then another 25% before the market opened the next day. Even action camera maker GoPro wasn't left out. Its shares rocketed over 40% in one day. And Opendoor Technologies, an online home flipping platform, became the poster child of this new frenzy with a jaw-dropping rally. More on that in a moment. So why the sudden surge in these unlikely stars? In a nutshell, individual retail traders, everyday investors, were feeling bold. With the broad stock market hitting record highs by mid-2025, some decided to roll the dice on riskier, low-price stocks. It's like a sequel to the 2021 meme saga. Same script, new cast. And just like any good sequel, the stakes and the swings were even higher. Let's break down two standout examples and what really happened behind the scenes. Quick question. If someone handed you $10,000 right now, would you know exactly what to do with it? Honestly, most people don't. And that uncertainty, well, that can cost you big time. So that's why I created something free just for you. Yes, F-R-E-E. And that is my Easy Mode Money Ladder. The Easy Mode Money Ladder is a simple step-by-step guide to help you figure out exactly what to do with your money and when. This is not a boring budget worksheet. This is a no fluff guide that tells you exactly when to build your emergency fund, how much to put in it, the best way to crush your debt, and the steps you need to take, which aren't that complicated, to start growing real long-term wealth. All of this one simple step at a time. No matter where you are in your money journey, this guide is for you. It will help you plan your next money move with confidence. And did I mention that it's free? Yep, totally free and will always be free. If you want this guide, and I think you should, then go to my show notes and click on the link to my Stan store. That's simply my internet storefront where I give away this guide for free. Download it, follow it, and let's put your money on easy mode. Now, back to the show. Opendoor stock price surged from about 50 cents to nearly $4 in weeks before tumbling back. It went on the kind of ride that made investors both giddy and terrified. Here's the play-by-play. In late June, Opendoor's share price was languishing around 50 cents, effectively a penny stock for this one-time real estate tech darling. The company had never turned a profit and was struggling with a flawed instant home buying business model. But by July 21st, a frenzy of buying, largely sparked by Reddit's Wall Street Bets community, propelled the stock to a peak of $3.99. That's a staggering 537% jump from its lows. For a brief shining moment, Opendoor became the first true woman-led meme stock. Its CEO, Carrie Wheeler, is possibly the first female chief at a meme stock company. But if anyone thought that fact would bring stability, they were soon proven wrong. So what sent Opendoor to the moon, as the Reddit crowd says? It wasn't booming home sales or stellar earnings. In fact, the business was looking pretty grim. Opendoor and its rival OfferPad had slashed home purchases and conducted deep layoffs just to survive the housing cooldown. Fundamentally, nothing had changed. No news, no profits, no sudden turnaround. Instead, social media hype lit the fuse. The infamous subreddit Wall Street Bets, known for its YOLO attitude toward stocks, turned Opendoor into its latest meme stock. Posts with rocket emojis and diamond hands flooded in, and Opendoor's trading volume exploded. On top of that, a prominent investor, Eric Jackson, a hedge fund manager, tweeted that his fund bought Opendoor and boldly predicted the stock could hit $82 long term. $82. That's the kind of extraordinary claim that can take on a life of its own in an online forum. Suddenly, a stock that many had left for dead was the new shiny object for thousands of retail traders looking for the next GameStop. And for a few days, it worked like a charm. Opendoor's share price shot up. Amateur traders posted celebratory screenshots of their gains, touting that they were holding on for dear life, for even bigger profits. But gravity catches up. By July 23rd, reality bit back hard. Opendoor stock plunged about 50% from its peak in mere hours. One moment it was nearly $5, the next it was back near $2. Reddit giveth and Reddit taketh away. Even after that drop, the stock was still up about 300% from its June bottom. It's a classic easy come, easy go scenario. The faster and higher a stock rockets on hype, the harder it can crash back down to earth. Case study number 2. Krispy Kreme became one of this summer's unlikeliest meme stock heroes. In mid-July, Krispy Kreme's shares quietly traded around $3, but then the online hype train left the station. Over just 2 days, Krispy Kreme's stock jumped about 60% in total. On Tuesday, it surged 26% in regular trading, and by Wednesday morning's pre-market, it was up another 25%. Briefly touching $5.73 at its high. That kind of spike is enough to give any investor a sugar high. But here's the kicker. Nothing revolutionary happened with the business to warrant that jump. In fact, Krispy Kreme has seen years of declining profits and even pulled its financial forecast for 2025 due to uncertainty. Wall Street analysts expect it to post a loss this year. Hardly a picture of a company on the verge of greatness. So why on earth did the stock soar? In one word, short squeeze. That's actually 2 words. Let's break that down in plain English. Many hedge funds and traders had shorted Krispy Kreme, meaning they bet against it by borrowing shares and selling them, hoping to buy back lower later. By July, roughly 32% of Krispy Kreme's publicly traded shares were sold short. That's a huge chunk, and it made Krispy Kreme a prime target for Redditors who love to stick it to the short sellers. So when the Reddit crowd and folks on platforms like StockTwits piled in and bought shares en masse, the price jumped and all those short sellers started sweating. As the stock climbed, short sellers were forced to buy shares back to cut their losses, which added more fuel to the price surge. That feedback loop is the essence of a short squeeze. a scramble by short sellers to cover their positions, driving the price even higher. For example, on Tuesday, Krispy Kreme traded 44 million shares in one day, compared to its usual 5 million. It was among the top trending tickers on StockTwits that day. Clearly, momentum had taken over. But by the end of that week, Krispy Kreme's stock gave back most of those gains, closing well below its hype-fueled highs. So what's the lesson? When you see a zombie stock, a struggling company, suddenly come to life, odds are it's not a miraculous turnaround, it's a meme-driven mirage. It only takes one viral tweet to send a junk stock soaring. This isn't investing, it's a popularity contest with your money on the line. At the heart of this meme stock resurgence is a high-octane hype machine powered by Reddit, X, StockTwits, TikTok, you name it. In 2021, we learned how a few viral posts on Wall Street bets could send millions of dollars chasing a stock. And here in 2025, that playbook is alive and well. Reddit's Wall Street Bets forum, now about 19 million members strong, was buzzing all summer with screenshots of trading gains and bold bets on names like Opendoor and Kohl's. It's essentially an online arena where everyone's chanting the same slogan, "Stonks only go up until they don't." Consider what happened on X. One hedge fund manager's bullish tweets about Opendoor, remember that $82 price target from earlier, helped legitimize the hype. StockTwits, a platform specifically for talking tickers, saw Krispy Kreme trend at number one as the squeeze was unfolding. And on Discord chat rooms and TikTok videos, traders were sharing hot tips and FOMO-inducing gains in real time. This is the virality factor. Once a stock starts trending online, attention begets more attention. It's like a digital fire. One spark, like a viral post or a catchy meme slogan, can ignite an inferno of buying from people who don't want to miss out. Meme stocks are not investments. They're schoolyard rumors with dollar signs. Hype spreads fast, and by the time reality shows up, it's usually too late. There's also a psychological aspect. Many of these retail traders are young and have grown up in an era of apps and instant info. They might have seen friends get rich quick in crypto or in the 2021 meme saga. FOMO, the fear of missing out, kicks into overdrive when they see a stock doubling in a day. And social media algorithms amplify this. The more outrageous a stock's move, the more it trends, which attracts even more traders who think, if others are in, I should be in too. It's a bit like a self-fulfilling prophecy. Enough people believe a stock will go up, so they all buy, and voila, it goes up, at least for a while. Meme stock proponents buy in low, promote the heck out of it online, and count on hordes of FOMO buyers to push it even higher. The goal is to get in early and get out before the hype dies, passing the proverbial hot potato on to the next person. Remember though, social media can create an echo chamber. Online communities often reinforce only the positive narratives, like, this stock is the next Tesla, and they downplay the risks or dissenting views. It's fun to share wins, it's not so fun to post about losses. So what you see is a highlight reel of big gains and confident predictions. Meanwhile, the quiet truth that no fundamental news supports the move can get lost in the noise. What's going on is essentially speculation for sport, egged on by the crowd. Here's a simple analogy. Social media hype in the stock market is like a schoolyard rumor. One kid whispers something sensational, a few kids start acting on it, and suddenly the whole school is in a frenzy over something that might not even be true. By the time the principal, or in our case reality, steps in with facts, a lot of kids have worked themselves up over nothing. It's hard not to feel the pull when you see stocks gaining 25, 50, even 100% practically overnight. But behind every meme stock rocket, there's a pile of risk that could come crashing down on latecomers. Meme stocks surge on online hype, not due to any firm fundamentals of the company itself, and when that hype fades, the stock will most likely crash. In other words, if nothing real is holding up the price, gravity will do its thing. Let's highlight a few red flags and risks that every investor should watch out for in this kind of environment. Here are 5 ways to spot a meme stock before it burns you. From fake hype to shaky finances, these red flags can be easy to miss. Red flag number 1, no new catalysts or news. If a stock is skyrocketing and there's no credible news, no earnings beat, no buyout rumor, no product breakthrough, be very suspicious. Both Opendoor and Krispy Kreme's rallies happened with no apparent reason to rally, reminiscent of the original meme stock craze. A sudden surge out of the blue often means it's driven by sentiment or feeling, not substance. Red flag number 2. Poor fundamentals. Many meme stocks are, frankly, troubled companies. Opendoor, for example, has never generated a profit and was cutting jobs just to stay afloat. Krispy Kreme's profits were falling, and it wasn't even confident enough to give a forecast. If you notice that a company's financial health is weak, for example, consistent losses, high debt, or shrinking revenue, that soaring stock price is on a very shaky foundation. Just because the stock is up doesn't mean the business suddenly fixed itself. Stock buyers piling in does not change anything about a company's actual viability. Red flag number 3, heavy short interest. A high percentage of shares sold short, say 20 to 30% of the float, can create the conditions for a volatile short squeeze. While that can ignite a fast rise, it's also a red flag that many sophisticated investors think the company's prospects are poor, hence the large number of short bets. It also means if you buy near the top of a squeeze, you might get burned once shorts have covered and they stop buying. When short sellers are forced to buy back in, they push the price up, but that's a temporary one-time boost. After they've covered, who's left to buy at these inflated prices? Red flag number 4, a meteoric rise in volume and volatility. Meme manias often come with trading volume that's off the charts. If a stock suddenly has 10 or 20 times its normal volume and wild price swings or halts for volatility, like with Kohl's, it's a sign you're in speculative waters. Volatility cuts both ways. Yes, it can spike up, but it can just as easily crash. The faster and steeper the climb, the more brutal the fall can be, as we saw with Opendoor dropping 20% plus in a day after its peak. And finally, red flag number 5, online hype and buzzwords. If your investment thesis sounds like everyone on TikTok is saying it'll go up, or you see a lot of rocket or fire emojis, beware. Beware of echo chamber language. Terms like to the moon, diamond hands, which is slang for never selling, or bag holder, which is the poor person left holding stocks after a crash, etc. These signal an environment driven by emotion and herd mentality. This doesn't mean the crowd can't be right for a time. They can clearly drive the price up, but it's not sustainable without real-world justification. If you notice yourself feeling swept up in the excitement, your heart's racing, you're checking the prices every minute, you're fantasizing about your quick riches, watch out. You might be trading on emotion, not logic. Are you still making minimum payments and getting nowhere on your pile of debt? Let's change that. If your credit card balance feels like a boss fight that you just can't win, well, I made something for you. It's called the Easy Mode Guide to Destroy Your Debt, and it gives you the exact plan to break free. In this 23-page guide, we'll bust through common myths, learn step-by-step strategies, and you'll discover how to pay off your debt faster, without shame, overwhelm, or giving up everything that you enjoy. Whether you're into the snowball method, the avalanche method, or have no idea what either of those mean, this guide is for you. If you're ready to finally start paying down your debt, then this guide speaks plain English and delivers results. It's just $19.99 and it's available in my storefront. If you click the link down below to enter my stand store, you'll see a big green button to purchase the guide. Please don't let another month slip by with no progress. Hit pause on this video, scroll down to the show notes, and click the link to download this guide. Now back to the show. So how do you navigate this minefield if you're tempted to play the meme stock game? First, only use money you can afford to lose. Treat it like casino money. Once you put it on the table, be prepared mentally that it could vanish. Second, have an exit strategy. If you do jump into a hot stock, decide in advance what profit you'd happily take or what loss you'd cut at and stick to it. Do not let diamond hands memes trick you into riding a winner all the way back down to zero. Remember, the last one holding the bag loses, and you don't want to be that person. Many late-to-the-party meme stock buyers in 2021 learned this the hard way, watching 90% gains turn into 90% losses when reality returned. A healthy dose of skepticism is your best friend here. Finally, consider the opportunity cost. While you're chasing the latest meme rocket, you might be missing out on stable investments or real opportunities. Is the adrenaline rush worth it? For some, the meme stock craze borders on gambling. It can trigger the same dopamine highs and addictive behavior as betting at a casino. In fact, experts have compared the meme trading frenzy to a form of gambling addiction, complete with compulsive behavior and chasing after losses. That's a serious warning sign. If you ever feel like you're trading just for the thrill or desperately trying to win back your losses, step back and seek help or advice. Remember, investing should ideally be boring. If it feels like a roller coaster, you're probably doing it wrong. Take a moment to write down one rule for yourself when investing in volatile stocks. For example, I will sell if my position drops 20%, or I will take profits after a 50% gain. Having a written rule can keep you honest when your emotions are running high. So what's the big takeaway from the meme stock resurgence of summer 2025? Meme mania isn't dead. It's just as wild and unpredictable as ever. On the upside, it shows the power, once again, of the little guys, the retail traders, to move markets in the short term. On the downside, it's a stark reminder that hype is not a sustainable investment strategy. A donut maker stock didn't triple because of any real change in donut demand or donut technology. Eventually, reality reasserts itself. So the payoff for you is hopefully a clearer understanding that for every meme stock rocket, there's a potential crash landing. If you decide to dance with these speculative plays, do it with eyes wide open, a plan in hand, and never bet more than you can afford to lose. By focusing on fundamentals and spotting red flags, you can enjoy the show without becoming part of its next cautionary tale. Make informed decisions and don't let FOMO be the boss of your money. If you enjoyed this deep dive and feel a bit more easy mode about your money now, do me a favor, follow or subscribe to the podcast so you won't miss our next episode. I'd also love if you share this episode with a friend or family member who's convinced the next meme stock will make them a millionaire overnight. They might just thank you later. See ya!
Thanks for listening to Your Money on Easy Mode. If you enjoyed this episode, then please subscribe and share it with a friend.